A man did everything right. He saved for 3 decades. He built a six-figure retirement account. He understood tax strategy better than most financial advisors. He retired early with a plan. And for 2 years, he executed that plan flawlessly. He moved $180,000 from his traditional IRA into a Roth, paying taxes at historically low rates while his income was nearly zero. He paid those taxes from a separate account, so every converted dollar could grow tax-free forever. His advisor told him he was nailing it. Then he turned 65. He enrolled in Medicare, and a letter arrived. His monthly Medicare premium wasn't $174, it was $443 per person. He and his wife were suddenly paying an extra $4,800 a year for the exact same coverage their neighbors were getting for a fraction of the cost. Not because he earned more income now. He hadn't worked in 3 years. Not because he made a mistake on his taxes. Everything was filed correctly.
The bill came from income he earned 2 years earlier. Income he'd already paid taxes on. Income he thought was over and done with. He did the right thing at the wrong age, and nobody told him that age mattered. This isn't a rare story. This is happening to thousands of retirees right now. Smart, careful people who researched strategies, consulted professionals, and still got blindsided by a rule almost no one explains until the bill arrives. Today, we're going to talk about why one specific age, 63, is different from every other age in retirement. Why decisions you make at 63 can cost you thousands of dollars a year in Medicare premiums, starting at 65. And why most financial advice completely ignores this timing trap until it's already too late to fix. Let's start with what most people think they know about Medicare costs. You turn 65, you enroll in Medicare, you pay a monthly premium. Simple, right? Not even close. Most retirees assume Medicare Part B costs the same for everyone. It doesn't. The premium you pay is based on your income, but not your current income. Your income from 2 years ago. This is called the 2-year look-back, and it's one of the most financially consequential rules in the entire retirement system that almost nobody understands until they've already triggered it. Here's how it works. In 2026, the standard Medicare Part B premium for most retirees is $174.70 per month. That's the base rate. If your modified adjusted gross income from 2024 was at or below $106,000 for single filers or $212,000 for married couples filing jointly, you pay the standard rate. But if your income from 2 years ago exceeded those thresholds, Medicare adds a surcharge on top of your standard premium. This surcharge is called the Income-Related Monthly Adjustment Amount. Everyone calls it IRMAA. And here's what makes IRMAA dangerous. It's not a gradual increase. It's a cliff. Cross the threshold by one single dollar, and your entire annual premium jumps immediately to the next tier. For a married couple where both spouses are on Medicare, crossing the first tier costs nearly $2,000 more per year. Not because of anything you did this year, because of income you had 2 years ago. Let me give you the exact numbers for 2026, so this is concrete. Standard tier. Below $106,000 single or $212,000 joint, you pay $174.70 per person per month. First IRMA tier. $106,000 to $133,000 single or $212,000 to $266,000 joint. Premium jumps to $244.60 per person per month. For a couple, that's nearly $1,700 more per year than the standard rate. Second tier. $133,000 to $167,000 single, $266,000 to $334,000 joint. Premium is $349.40 per person per month. Third tier, $167,000 to $200,000 single, $334,000 to $400,000 joint. Premium is $454.20 per person per month. Fourth tier, $200,000 to $500,000 single, $400,000 to $750,000 joint. Premium is $559 per person per month. Top tier. Above $500,000 single or above $750,000 joint, premium is $594 per person per month. For a married couple in the top IRMA tier, Medicare Part B alone costs over $14,000 per year, compared to under $4,200 for the same couple below the first threshold. Same Medicare coverage. Different income from 2 years ago, and every single dollar of the difference is based not on what you earn today, but on a tax return that's already filed and already passed. Now, here's the rule that changes everything at age 63. Most people start Medicare at 65. That's when the standard Medicare enrollment window opens. When most retirees enroll in Part B and Part D, Medicare uses the 2-year look-back to set your premiums. Your Medicare premium in a given year is based on your tax return from 2 years prior. So the premium you pay in your first year of Medicare at 65 is based on your income at 63, not 64, not 65. 63. That means if you're 63 right now, every income decision you make this year is directly setting your Medicare premium when you first enroll at 65. The IRA withdrawal you take, the Roth conversion you do, the stock you sell at a gain, the rental property income you collect. All of it lands on a tax return that Medicare will pull 2 years from now and use to calculate what you pay for coverage every month. If you're 62 right now, your income this year goes into the look-back window for age 64. That still matters because your second year of Medicare premiums at 66 will be based on your income at 64. But your first year at 65 will be based on what you earn at 63. If you're 61 right now, you still have a full planning window. Your income at 61 affects your Medicare premium at 63, which is before Medicare even starts. You have time to structure things correctly before the clock begins. But if you're already 63 and you haven't thought about this, the decisions you make between now and December 31st of this year are among the most financially consequential of your entire retirement. Let me be very direct about something that most financial advisors and most retirement planning articles miss completely. They focus on tax brackets and Roth conversions without ever mentioning the specific age dimension. They tell you to convert while your income is low. That's correct advice. What they often forget to add is that low income at 63 still has a consequence 2 years later. Even if you pay zero income tax on the conversion itself, the tax cost and the Medicare cost are calculated separately. You can pay no income tax at all on a Roth conversion and still trigger thousands of dollars in extra Medicare premiums because the conversion pushed your modified adjusted gross income over the ERMA threshold. These are two completely separate calculations, and almost nobody explains them together. Let me walk you through 3 real situations so you can see the dollar amounts and recognize your own circumstances in one of them. David is 63 years old. He retired at 61 from a manufacturing company after 34 years. He has a traditional IRA worth $420,000 and a small pension that covers his basic bills. He knows about Roth conversions. He's been reading about them for 2 years. His income is low. His tax bracket is nearly empty. This year, he decides to convert $190,000 from his traditional IRA to a Roth IRA. His modified adjusted gross income for the year, including the conversion, lands at $139,000. That's above the first IRMA tier threshold of $106,000 for single filers. 2 years later, David enrolls in Medicare at 65. His standard Part B premium should be $174.70 per month. But because of the IRMA look-back, his premium is $349.40 per month. That's $174.70 more per month than the standard rate. Over 12 months, that's $2,096 more per year that David pays for the exact same Medicare coverage his neighbor, with lower prior year income, pays less for. Over his first 2 years on Medicare, before the look-back shifts to a different income year, the ERMA surcharge cost him nearly $4,200 in extra premiums. That's money that came directly out of the Social Security check he was counting on every month. David's Roth conversion was probably the right long-term decision. But if he had done the same conversion at age 61 instead of 63, or if he had split it across 2 years to stay below the IRMA threshold, the Medicare surcharge would not have applied. Same strategy, different timing, nearly $4,200 in savings. Sandra and her husband Thomas are both 63. Sandra still works part-time and earns $48,000 a year from consulting. Thomas receives Social Security of $22,000 per year. They also sold some appreciated stock this year. Stock Sandra's father had given her decades ago. The gain on that sale was $60,000. Between Sandra's consulting income, Thomas's Social Security, the stock sale, and a small IRA distribution Thomas took because he needed some cash for a home repair, their combined modified adjusted gross income for the year lands at $245,000 as a married couple filing jointly. Sandra and Thomas had no idea any of this would matter in 2 years. They were just managing their finances the way they always had. Nobody told Sandra that selling appreciated stock at 63 would set her Medicare premium 2 years later. Nobody told Thomas that the IRA withdrawal for a home repair would count. They weren't making unusual financial decisions. They were just living their lives. 2 years later, they start Medicare. Their first-year Part B premium is $340.40 per person per month. Together, they're paying an extra $4,193 per year, more than they would have paid if their income had stayed below the first tier. Over the 2 years that those premiums apply, before the look-back shifts to a different income year, that's nearly $8,400 in extra Medicare costs. And the painful part is that most of the income events that triggered it were things they could have timed differently. The stock sale could have been spread across 2 years. The IRA withdrawal could have come from a taxable account instead. None of these required complicated strategies. They required knowing the rule before the decision was made. Not after. Margaret is 63 years old. She's a retired nurse from Georgia. She has no IRA. She has a defined benefit pension from the hospital she worked at for 27 years, and she receives Social Security. Her combined income is $64,000 per year. She's never heard of IRMA. She doesn't own stocks. She's never done a Roth conversion. She pays her bills, lives modestly, and doesn't think about Medicare costs because she assumes they'll be the same for everyone. When Margaret enrolls in Medicare at 65, she pays the standard premium. Nothing about age 63 matters in her situation because her income at 63 was below the threshold, and she had no large one-time events. Margaret is actually the majority of retirees. Most people on Social Security and modest fixed incomes never hit the IRMA threshold, and age 63 is genuinely not a critical year for them. But if you have a traditional IRA, a 401k, a taxable brokerage account with appreciated holdings, rental property, stock options from a job you left, or any source of income you can control in timing, or amount, you're not Margaret, you're David or Sandra, and the decisions you make at 63 can cost you thousands of dollars per year in higher Medicare premiums for multiple years going forward. Now let me show you what makes age 63 genuinely unique among all the ages in retirement. It's not just IRMA. It's the fact that 3 completely separate financial systems collide at this one age simultaneously, and each of them wants something different from your income. The first system is income taxes. At 63, many retirees are in what planners call the gap years. They've retired, but they haven't yet started Social Security or required minimum distributions. Their income is at its lowest point in decades. This makes 63 an attractive time for Roth conversions, capital gains harvesting, and other income-generating tax strategies. The tax argument says, generate income now because the tax rate is low and the opportunity won't last. The second system is ACA health insurance subsidies. If you retire before 65 and you need health insurance before Medicare starts, you're likely buying coverage through the ACA marketplace. ACA subsidies are based on your modified adjusted gross income. The lower your income, the more financial help you receive with your premiums. Before 65, a couple who manages their Meiji carefully can sometimes save $15,000 to $25,000 per year in insurance costs, compared to someone who lets their income run high. The ACA argument says, keep income low, because the subsidy shrinks or disappears as income rises. The third system is IRMA. Your income at 63 sets your Medicare premium at 65. The IRMA argument says, keep income below $106,000 single or $212,000 joint to avoid the surcharge at 65 and 66. The problem is that these 3 systems don't want the same thing from your income at 63. Let me give you a real example of what this tension looks like in practice. Take a couple, both 63, who retired early. They have $400,000 in a traditional IRA, $200,000 in a taxable brokerage account, and $100,000 in a Roth. They're buying health insurance on the ACA marketplace before Medicare starts. If they keep their MAGI at $70,000, they qualify for a significant ACA subsidy. Their health insurance costs are manageable, but at $70,000 of income, the Roth conversion they can do this year is small. They have roughly $30,000 of bracket space available before their income starts triggering additional consequences. If they push their MAGI to $150,000 by doing a larger Roth conversion, they lose their ACA subsidy entirely. Their health insurance costs jump by $12,000 to $18,000 for the year. But they move $80,000 more dollars into the Roth. 2 years later, that conversion income shows up in the IRMAA calculation, and they pay a higher Medicare premium at 65. The short-term cost is real. The long-term benefit in reduced RMDs and tax-free Roth growth might be greater, or it might not be, depending on their situation. There's no universal right answer. The answer depends on how much is in the IRA, how long they expect to live, what their tax rates will be at 73 when RMDs start, and what their income looks like going forward. But here's what's non-negotiable. You cannot make this decision correctly without understanding that all three systems are in play at 63 simultaneously. The person who gets this right is not smarter or wealthier than the person who gets it wrong. They're simply the person who knew all three rules existed before making the decision. This is why generic retirement advice, convert while your income is low, is not wrong but is dangerously incomplete at age 63. Let me walk you through the full timeline so you can see exactly how the 2-year look-back affects each year of Medicare coverage, and why the window for action is more specific than most people realize. Your Medicare premium in 2026 is based on your income in 2024. Your Medicare premium in 2027 is based on your income in 2025. Your Medicare premium in 2028 is based on your income in 2026. The pattern continues every single year you're on Medicare. If you start Medicare in January of the year you turn 65, your first-year premium is set by your income 2 years prior, when you were 63. Your second-year premium is set by your income when you were 64. Your third-year premium is set by your income at 65. This means the IRMA window doesn't stop at 63, it's ongoing. Every year you're on Medicare, your premium for the current year is being set by decisions you made 2 years ago. The reason 63 is uniquely important is that it's the first year that directly affects your Medicare costs. It's the starting gun. But the race continues for as long as you're on Medicare. A retiree who's 75 today and had a large required minimum distribution 2 years ago at 73 is paying IRMAA charges right now in 2026 because of income they had in 2024. The look back never stops. It follows you through every year of retirement. The difference is that at 63, you still have the ability to control the income before it happens. By the time required minimum distributions begin at 73, the forced nature of those withdrawals makes the income much harder to manage below the MAGI threshold. This is also why Roth conversions done early, at 60 or 61, are so powerful from an IRMAA perspective. The income from those conversions is already 2 to 3 look-back cycles behind you before you even start Medicare. The surcharges simply don't reach back that far, and this is exactly why the strategic advice from every serious retirement planner is to do your heaviest Roth conversions before age 63, if at all possible. Not because 63 is the only year that matters, but because it's the first year where Medicare starts collecting the premium based on what you did. Here's your action checklist, what you need to do based on exactly where you are right now. If you're 60 or 61 right now, you're in the cleanest conversion window you'll have. Your income at these ages is not in the IRMAA look back for your first years of Medicare. You have the most flexibility for Roth conversions. Use it deliberately. Model how much you can convert each year while staying in a tax bracket you're comfortable with, and convert as aggressively as you're willing to over the next 2 to 3 years. Every dollar you move to Roth now is a dollar that will never appear in an IRMAA calculation, for the years immediately following your Medicare enrollment. If you're 62 right now, you're 1 year away from the first IRMAA critical year. Your income this year sets your Medicare premium at 64, your second year on Medicare. It's still a productive conversion year, but you should begin modeling exactly where your MAGI threshold sits and what your projected income will be at 63. The 2 years of 62 and 63 together form your initial IRMAA window, and they deserve a coordinated plan, not independent decisions made 1 year at a time. If you're 63 right now, stop and do this before making any income decision for the rest of the year. Pull up your most recent tax return and find your modified adjusted gross income on line 11 of your Form 1040. Now calculate where you stand relative to the threshold for your filing status. For single filers in 2026, that's $106,000. For married filing jointly, it's $212,000. Every Roth conversion, stock sale, IRA withdrawal, or other discretionary income event this year should be sized to stay below that threshold, unless you've specifically modeled the long-term Roth benefit and decided crossing it is worth the premium cost. Don't guess. Run the numbers or have someone run them for you before December 31st. This is the single most important financial deadline you have this year. If you're 64 right now, your income this year sets your second-year Medicare premium at 66. The same analysis applies. This is also a year where many retirees start Social Security benefits, which adds to their taxable income and makes managing the IRMA threshold more challenging. The man I told you about at the beginning paid nearly $5,000 extra in Medicare premiums in his first year of coverage, based on a Roth conversion he did at 63. 2 years later, when the look-back shifted to a different year where his income was lower, his premium dropped back to the standard rate. The IRMAA surcharge wasn't permanent, but it was real, and it was avoidable. He did the right thing at the wrong age.